So if I'm management running a business and I want to obtain resources, such as money, I would definitely emphasize the good and keep quiet about the bad. So, what's in place to ensure management, the preparers of financial statements, are providing accurate financial information, advising stakeholders about not just the good, but the bad and the ugly? What we're talking about is management bias. Management might be motivated to de emphasize the negatives and highlight the positives because they want the resources from external stakeholders. They want and need money. Because of that, management might bias the financial information by doing things such as overstating assets and net income, and also understating liabilities and expenses. Information that is biased is not useful information because external stakeholders, when using that information, will come to the wrong conclusions and make incorrect decisions. What might motivate management, the preparers, to bias the financial information they provide? I can think of a few pressures that management might be under that would cause them to potentially bias the financial information. First, if financial information is used to assess management's performance, how effectively and efficiently they have managed the money invested or lent to the business, it might pressure management to make the financial information look as good as possible. Second, if management is bonused based on, say, net income or income before income taxes, or if they get stock options based on the market value of the business's shares, that might pressure management to provide biased information. Third, if analysts have expectations which have been made public, there's pressure to ensure that their expectations are met. If the business does not meet expectations, it will have a negative impact on their share price, which can negatively impact the business's ability to get capital in the future or negatively impact their ability to meet their bonus targets. Finally, businesses may have debt covenants with creditors that require them to maintain, for instance, specific debt to equity ratios or current ratios. If those ratios fall below what is expected, the company may be required to repay the loan immediately, which again provides motivation to management to bias the financial information provided. Now, if the objective of financial reporting is to provide general purpose financial statements that are useful to stakeholders to make decisions, then what is stopping the preparers from biasing the financial information to begin with? GAAP, Generally Accepted Accounting Principles. Basically, accounting standards which are generally accepted and universally practiced. Generally accepted means that either standard setters have created a principle or that over time a specific practice has been accepted as appropriate because it is used universally. Accounting standards such as International Financial Reporting Standards, short form IFRS, and Accounting Standards for Private Enterprises, short form ASPE, require that transactions and events be recognized, measured, presented, and disclosed in a specific way. So, what's in place to ensure management, the preparers of financial statements, are providing accurate financial information? GAAP.